Hi, good morning. Welcome to Morning Kappa. Here we come to the week 2 of July with futures. Before we begin, I would like to highlight some disclaimer. Trading in futures and options involve a high level of risk due to leverage and may not be suitable for all investors. This presentation is intended for educational and informational purposes only and does not consist an invitation or recommendation to buy or sell any financial instrument. Please consult your licensed broker or financial advisor before making any trading decision. So let's start. Global markets enter week 2 with a clear split. Western equities are showing signs of renewed optimism while Chinese large cap face mounting defensive pressure. The sharp liquidity reset that dampened last week's performance has now eased, giving a way to selective buying and sparking a broad relocation of capital across global boards. For local products, FKLI and CPO are displaying muted momentum, holding steady in neutral short-term profile. In Asia, Hang Seng Index continued to reflect a deep undercurrent of institutional selling, remaining stuck in negative stand for 2 consecutive weeks. More notably, A50 has broken down from neutral into negative. Meanwhile, Nikkei 225 is still holding steady in neutral in short-term view. In the US market, the Dow Jones is outperforming among major indexes. It has shown a strong bullish trend since last week and has now shifted into a positive stand in week 2. Meanwhile, the Nasdaq and S&P remain trapped in a short-term neutral holding pattern, though both continue to maintain their bullish long-term outlooks. And in the grain complex, corn and soybean have paused their recent downtrend, transitioning into negative into a neutral stand after a strong bullish signal yesterday. Soybean oil has surged from neutral into fully positive this week, supported by a sustained bullish momentum since Monday. For metal, gold and silver have stabilized, moving to neutral this week, while their long-term overall trend remains firmly positive. Within the metal complex, copper continued to lead structural, holding a positive profile across both week 1 and 2, supported by robust industrial demand. Crude oil maintained its sideways grind in a neutral profile, underpinned by a long-term positive supply flow. Natural gas has shifted into a neutral stand in week 2, showing sign of recovery since last week. Well, gold steady around 4,150 on Tuesday after a volatile start to the week as investors awaited the minutes of Federal Reserve June meeting for fresh guidance on the interest rate outlook. Data released last week showed that U.S. job growth slowed sharply in June, while payroll figures for the previous 2 months were revised lower. This prompted markets to scale back expectation of a near-term rate hike. Higher interest rate typically weigh on non-yielding assets such as gold. As a result, investors are now looking to Fed minutes for clearer direction on short-term policy before committing to a defined trading stand. At present, gold is attempting to break 4,200 level after rebounding for 4,120 level. The next resistance level to monitor are 4241, 4430. After, if any failure to stay above 4120 may lead to a continued downwards to 3935. WTI crude oil futures recently rebound from 67 per barrel after hovering near their lowest level in more than 4 months, as signs of rising supply continue to weigh on prices, where vessel traffic through the Strait of Hormuz showed further recovery. Prices have seen risen by more than 1.5 following reports of Iranian attacks on commercial vessels near the Strait of Hormuz, underscoring persistent security risks despite ongoing diplomatic efforts. Although crude oil has returned to a pre-conflict level, underlying pressure in the market remained intact. Following the recent ship attack near the Strait of Hormuz, the flow of oil tanker through the Strait of Hormuz may slow, which could temporarily stabilize crude prices above 68.05 level. As a result, prices are now attempting to stabilize above 70. 72 and after rebounding from 68.05. If the resistance breach, the next resistance is 46.74. Any failure to support above 72, market will tend to move back to 68.05. Well, before we look ahead, let's audit last week. Unfortunately, we have two calls with realized losses. First is FKLI. We triggered our last reference price last week, has reached our potential loss, capping the loss at 500. The next call was micro gold. It has reached our potential loss prices, capping the loss at USD 300. Well, as usual, the highlight of our briefing, the future market call, building on last week momentum, we continue to anticipate a potential opportunity in FKLI. Initial margins 4,000, short-term chart setup is positive. Reference price is 1678.5. Potential profit price is 1695, 1702. Capping the gain to 825 to 1175. Potential stop loss is below 1667 and capping the potential loss at 575. The next call was in micro natural gas, which is September month. The setup is considered a swing trade and may not materialize in a short term. The initial investment is 315.70 cents. Short-term chart setup is positive. Reference price is 3.025 and potential profit price is 3.417, 3.747 and 4.119, targeting a gain of USD 392,722 and 1094. So potential stop loss is below 2.8, capping potential loss to 225. The risk and reward ratio is 1 to 1.7 to 4.8 times. So we are pleased to announce the launch of our new client exclusive initiative, where the AM/PM market guide, which has been active since June 2026, strategically designed to assist you in navigating CPO, the crude palm oil futures, in an intraday movement with precision. This service provides 2 daily market calls, one in the morning and one in the afternoon. Please note that all recommended strategy are strictly intraday with no over session position retained. As this premium feature is reserved exclusively for RHB IB clients only, we invite you to contact our dealer or reminder for further information on how to access these features. Well, if you are completely new to the futures market, we have got you cleared, covered with our TWP 2.0 campaign, which gives you up to 500 zero brokerage trading to help you start your trading journey. Ready to dive in? Get in touch with us or drop an inquiry on our RHB Invest website today. The good news is every trade you place will also be automatically qualify you for trade and win lucky draw entries, giving you chances with a chance to win a Tesla or take away a monthly prices iPhone 17. But if you are from JB, we are delighted to invite you to our exclusive physical event entitled Futures Insight on 18th of July in JB Holiday Inn, where 3 special guest speakers, David Low, Joseph, and myself, will share insights on market trend, trading opportunity, and strategy to help you navigate today's dynamic environment. Don't miss out. And that's all from me. Thank you for your time. I'll hand over to the next speaker. Thank you.
All right. Thank you, Megan. All right. Morning, everyone. And let's look at the market together, and we can see that yesterday, right, when this morning, what we have learned is that US have reinstated sanctions on the Iranian oil, right, after the commercial LNG oil tankers are being attacked, right? 3 ships were being hit by the projectiles, and But what's important is that look at the price actions in the oil, right? The oil have staged a rebound yesterday, showing that positive price actions right now. Meanwhile, also cross-check the Trump social media, right? As of now, there's no hard or aggressive message that posted by Trump on his social media, right? I think that we shall see what happen on the oil price for the coming week. But at this juncture, I still think that the oil price should have more downside risk than the upside risk. And at this juncture, the other piece of news that really caught my attention this morning is trying to find out um, what is the reason that the Hang Seng Index has been moving downwards for the past 2 months? Although that last 1 month, Hang Seng have a strong counter trend rebound, I do find another piece of news that the Iran may find it. This is a new report by CNBC that they mentioned that Iran may find it difficult to clear oil inventory after the sanctions have released because one of their major buyers, China, is not buying aggressively in the open market right now. So there could be a few reasons. Maybe a price is not low enough, and the other reason is that China have a sufficient oil inventory right now, and the economic activities is not as strong. And you also have learned that from Barnabas' team, they are having cautious or negative stock sentiment right now on the Chinese market, and that is also another signal showing that Chinese market may face some headwinds right now. So nevertheless, we keep our bearish stance on the Hang Seng Index. Despite that it's moving upwards, we have our stop loss at 500 point level. And meanwhile, at the China A50, you can see that for the past 1 week, the shares have underwent a very strong corrections. Yesterday is just lingering at 900 point level. At this juncture, you can clearly see that A50 is trading below the three moving average right now. Hence, the bearish trend is still in play at this juncture. Now, meanwhile, although the market is having a negative sentiment right now, we do see two counters as sparking the trend in the Hong Kong market. Firstly, Geely Automobile 175, they have break past 19 Hong Kong dollar. The next resistance will be 20 and followed by 21, and downside support is 18, and then on we have the this Cathay Pacific Airways 23 stock code 293, right? Yesterday they are eyeing to break past 13.50 Hong Kong dollar. If breakout happens, Cathay will be moving towards 14 and followed by 14 and 60. Downside support is 12.80, right? So these two stock have show a very resilient trend while the broad market is undergoing a correction. Meanwhile, right at the A shares market, right, I can see that this stock 600584 Shenzhen TechWin Semi Technology is staging a very strong rebound on the back of high volume. So in the event that it break past 910 renminbi, you may move towards 1000 and 1080 renminbi. Downside is 805 renminbi, right? I do see that this stock is a strong momentum at this juncture. Then on looking at the gold price, what we have shared during our CME events is that apart from looking at the indicators such as moving average, the other leading indicator that I rely on is the yield spread between the 10-year bond yield and also the inflation expectations. So this formula you can key in into your trading view, and then you can get this chart. How we read it is that this is a negative relationship. As long as the this index is moving upwards, gold will have a tendency to move lower. So this morning you can see that the gold price have a gap down, right, and likelihood that gold may stage a fresh attempt to break on the 4,000 level. Although the gold have rebound for the last few sessions, you look at this index still continue to move upwards, showing that in terms of correlations, slightly that gold will have a downside risk. So we stick our this stop loss point as 4,004, and meanwhile, looking at the S&P 500, right, the index have undergoing corrections, but look at their peers. The E-mini Dow Jones index is continue to move upwards. So this shows that the funds are moving out from technology stocks into the traditional brick and mortar counters. So at this juncture, the E-mini is testing their 500 point level. So if we are looking at E-mini futures, what is the index or the advanced uh, other indicator that we can actually rely on? Now, this is another indicator that I shared during the CME workshop, right, where the formula is US 0 2 year minus US 0 10 year. This is the bond yield spread. As you can see that when the index is moving upwards, this index is likely to move down, and when this yield spread moving downwards, index are likely to move up. We can see that past 1 to 2 weeks time, this index is moving downwards, and in this environment, likelihood that the Dow Jones will be moving upwards, and this actually shows that yesterday, right, the Dow Jones continue to test on the 500 point level. Okay, so I just want to follow up a few counters that we have published in our technical report recently, right? One that actually caught my attention is Johnson and Johnson. 2 weeks ago, we mentioned about Johnson and Johnson, and yesterday, it have surpassed our resistant 1 and resistant 2, and right now, even break past the resistant 3 at 265. So I'm looking at a higher resistance 4 and 5 at 280, and followed by 295. Downside support will be at 250. And then on LLY, Eli Lilly is another counters that we have also published in our technical report. It's testing the R1 at 1250. So since the tech stock is undergoing corrections, I think that the funds will be looking at non-tech stocks, which is likely to be healthcare, right, or healthcare related counters. So I think that LLY have more upside potentials to break 1250 and followed by 1003. Right now, if you really want to look at the tech stocks, I think one of the tech counters that I mentioned is looking at possibility of the IPO of the OpenAI, which I'll be paying attention to Microsoft. Right, as you can see that last 1 week, Microsoft has a very strong counter trend rebound. Now it climbed above 390 US dollar. So the R1 will be 420 and followed by 450, right? So the downside will be at 350. So if the Microsoft can keep trading above 390, right, it will weaken the price volume profile at this juncture. Okay. Then on the other counter that mentioned to you during the Monday 2 days ago is actually RTX defense related counter. You can see that on the Friday sessions, the RTS have break past this volume profile resistance. So usually if a stock is going on a downtrend corrections, they can't even climb above the resistance. But this juncture, we can see the RTX firmly break past this volume profile resistance. It shows that this bullish momentum is really, really very strong. So I think that they will likelihood have a more follow through momentum towards 208 and followed by 220 on the RTX. So these are the few ideas that I shared with you, right, while this US tech stock is undergoing corrections, mini corrections. As for Malaysia, we still keep a bullish bias on the FKLI. We set our stop loss at 1650. Meanwhile, the FCPO is undergoing corrections or consolidations sideways right now, taking cue from the movement of the oil price. We set our stop loss at 4,007, and let's see how the FCPO move this week in tandem with the oil price. This morning, we have two ideas for Malaysia market. Firstly, the Sarawak oil pump that climbed above 4 ringgit 85 cents. Now, as you know that one of the story in the plantation is the El Nino, right? And the scientists have mentioned that this year El Nino is going to be stronger than the previous one, and likelihood plantations company will have more earnings next year or the year following. So based on technical, right, can see that SOP break past 4.85 heading towards 5.15 and followed by 5.35. Downside support is 4.65. Hibiscus Petroleum have a strong rebound yesterday, follow the increase in the oil price. We have climbed above 1.85, now heading towards 2 ringgit and followed by 2.15. So on the downside, we see the support at 1.70. So we have two breakout stocks. Firstly, the SOP Sarawak Oil Palm, followed by Hibiscus Petroleum. So I'll pass the stage to Wei Siang on the consumer report. Thank you.
Okay, thanks, Joseph. Morning, everyone. Let me continue with sector thematic report we published this morning. Essentially, this is after we hosted a physical investors conference 2 weeks ago. The conference is themed or titled Consumer and Healthcare Sectors, the Safe Havens Amidst Prevailing External Risks. In the event, we welcome more than 60 institutional clients, as we believe the differentiated setting of the conference has garnered strong investors' interest, as opposed to the typical conferences that our competitors have held. They largely and repeatedly showcase familiar listed companies. Ours is differentiated as we featured 10 speakers from mostly private companies and associations with the aim to offer fresh and exclusive industry insights. The representative that we have are from Kanta Insights, Malaysia Retail Chain Association, MRCA, Mary Brown, Luckin Coffee, Laundry Bar, Bila Bila Mart, and Kasem. They are all unlisted private companies. So essentially, the conference reaffirmed our view on consumer sector's defensive profile, supported by resilient domestic consumption and value-seeking behavior. While most speakers have observed a more cautious consumer sentiment, the discussion suggested that the market still offers enough opportunities for the businesses that can adapt to the evolving consumer behavior. This is very much underpinned by the stable employment and favorable fiscal policies in Malaysia. Consumer demand remains resilient for essential staples, food, value retail, convenience, and affordable indulgence, while discretionary categories may require stronger value propositions to drive conversion. This shift towards smart value, together with a higher adoption of AI to understand customer preferences, optimize inventory, and fine-tune pricing or promotion, should support business to stay relevant and protect margins amidst the environment of rising operating costs. Overall, the conference reinforces our positive view on the sector, with a preference for the essential categories, strong scale of operations, and value-seeking economics. Sector-wise or valuation-wise, consumer sector valuation has derated to a more undemanding level at 23 times forward PE, which is at negative 1.5 standard deviation over the long-term mean, while the earnings visibility has remained relatively resilient for some of the selected names. Our top picks for the sector will include Nestle, EcoShop, and Mr. DIY. That's it from the for the consumer section. I will now pass on to Eddy to take you through the healthcare side of things. Thank you.
Hey, thank you, Wei Xiang. So this will be the healthcare's insights from our report. Basically, in terms of hospital operators wise, they will continue to be highly resilient and defensive paid due to aging population. However, the sector is rapidly moving beyond reactive sick care and towards long-term health preservation. Some of the data mentioned in our conference is that, while Malaysia's life expectancy stands at 74 years, the WHO actually highlights that the health-adjusted life expectancy is just at 63.9 years. This means that the average Malaysian actually spends their final decade living with chronic diseases as well as disabilities, and that is driven by lifestyle deficits as well as non-communicable illnesses. So in response, we understand that consumers are taking control. They are increasingly treating health as wealth, as well as spending out-of-pocket money today to reduce future health risks. And key drivers mentioned by the panelists includes post-COVID awareness, the accessibility of wearable health data, as well as this all these large language models, which has driven patients arriving at consultations highly informed and seeking collaborative discussions with doctors rather than just simply receiving instructions. And if you were to look at the wellness economy as a whole, right, in Malaysia, that actually reached $31.8 billion in 2024, and that is about 7.6% of Malaysia's GDP. And amongst this, while personal care still dominates a significant portion, the fastest growing segment is actually public health, prevention, as well as personalized medication or medicine, which expanded 12.6% on a 5 years CAGR basis to $2.4 billion. And that means that consumers are aggressively directing funds towards routine screenings, diagnosis tests, as well as supplements and nutraceuticals. That's it. We do not view this preventive wellness trend as a substitute for traditional hospital services, but as an expansion of the broader healthcare ecosystem, right? So traditional clinical demand remains inelastic and heavily insulated against macroeconomic pressure, considering that we do also have capacity constraints in the public healthcare segment, right? So all in, we are maintaining our overweight stance of this sector. This would be continued to be anchored by the inherent inelasticity of clinical demand, which would continue to provide a defensive shelter against potential inflationary risks, and also the broader geopolitical volatility. Our topics here remains unchanged. It will be KPJ, LAC Med, as well as Duo Pharma Biotech. Right. I do have another separate report besides this thematic report. This will be the healthcare sector update with regards to the announcement of the rollout of the base MHIT product, which is expected end of July, right? This will be the pilot phase program for Medi Asas. Medi Asas is the base MHIT plan, right? And that is designed to actually improve affordability while serving as a stepping stone towards the phased implementation of this diagnosis-related groups payment system in private hospital. So two products here, namely Medi Asas Teras, which is a standard plan, and Medi Asas Flexi, which is standard plus plan. Both of these will be piloted in Klang Valley over a 3-month period starting end of this month till October 2026. And the pilot actually involves 6 insurers as well as Takaful operators, namely AIA, Allianz, your Great Eastern, Prudential, Etika, as well as Syarikat Takaful Malaysia Keluarga. And this will be together with selected hospitals. While the list of participating hospitals has yet to be announced, we are expecting hospital operators under coverage to participate, albeit selectively with their hospitals in the Klang Valley. The indicative monthly premiums for this Medi Asas is expected to range between 60 ringgit to 550 ringgit for individuals entering the plan up to age of 70, with coverage extending up to age of 85, right? And the final pricing of this MHIT product will be confirmed ahead of the nationwide rollout in early January of 2027. Some of the key features of potential implications. This one we extracted from the earlier white paper of the base MHIT plan. In that paper, they actually outlined a $500, a 500 ringgit deductible alongside two-tier co-payment mechanism. So for tier one, so there'll be tier one and tier two. Tier one would be in-network hospital, and tier two would be out-of-network hospital. The tier one hospitals, which is in-network, there'll be no co-payment required other than the 500 deductible. And for tier two out-of-network hospitals, there'll be a 20% co-payment, right? And we see two key implications from this. Number one relates more on MHIT. So hospitals that are not selected as preferred panel hospitals under the MHIT program could see some pressure in terms of patient volumes, although the impact on premium operators should be limited given their focus on high equity cases. Number two ties together more with DRG, with MHIT stepping as a stepping stone into DRG. Basically, number two talks about pricing benchmark against the lower and mid-tier private hospital costs. May require the premium operators to actually offer more standardized, cost-efficient packages, limiting their ability to monetize premium branding from the M40 segment, right? That said, we still believe that KBJ, amongst the listed coverage, listed hospitals that is under coverage, KBJ is the best position to benefit from the eventual implementation of MHIT plan as well as the DRG payment system, particularly through its extensive network of secondary and community hospitals that operate at a relatively lower cost base, and with room to accommodate higher patient volumes, potentially preserving margins under DRG-based reimbursement structure. That's it. This pilot program for MediASAS, it's expected to have mutual impact on the hospital operators, right? So we are keeping our overweight call on the sector. Key downside risk here remains, higher than expected operating costs, the lower than expected patient volumes, as well as revenue intensity growth, as well as some of these adverse regulatory changes. So that's all from me. Sorry, my topics would be again KPJ, LAC Med, as well as Duo Pharma, right? And that's all from me. I believe I'm the last speaker for today. We'll see you back again here at Morning Cuppa at 8 tomorrow. Thank you.